Hey, this is Mike Diercksen from Proactive, and you're listening to the Building Bite podcast. Tune in as we spotlight our guest, Ken Simonson, Chief Economist at AGC. Our episode is focused on the September U.S. Construction Outlook Report. For more information on this episode and others, please check out the Building Bite at www.buildwithproactive.com.
Welcome to the Building Bite podcast, a podcast for construction contractors, owners, and insurance professionals, where you'll hear from the experts about key topics to help you be successful. I'm Chris Epps. I'm a senior director with Proactive, and I'm joined here with my co-host, Mike Diercksen, our manager of marketing and business development. And today we welcome back Ken Simonson, Chief Economist with the Associated General Contractors of America, or the AGC. Ken, how are you this afternoon?
Doing fine, thanks.
And Mike, how about yourself?
Doing great, Chris. Happy to be back. Happy to have Ken back on the show and excited to hear about the September report.
Today, we're lucky enough to have Ken back to discuss his most recent publication, the September 2023 Construction Outlook Report. So, Ken, before we dive in, what would you say is the most striking thing coming out of this report, or maybe something you didn't expect to see?
Well, I think there are three things to focus on. What's going on with labor availability and cost, some good news overall about materials cost, but some significant exceptions there. And then still hot non-residential market, but some question marks about the areas that may suddenly soften.
Excellent, Ken. And, it's such a treat to be able to sit down with you today to talk about the report. But for our audience, if you're listening on a streaming service and not on video, you can find the report via PDF on our website. That's www.buildwithproactive.com. And with that, Ken, we will turn it over to you if you'd like to share your screen and walk us through the September findings.
All right, I'm happy to do that. Let me start with the labor situation. This is illustrated here by a chart that shows what's happened to construction employment and total non-farm payroll employment since February 2020, the month before the pandemic really struck. And what you can see is that the non-residential employment, shown by the red line, pretty well tracked what happened with the overall economy until recently. In the last few months, that year-over-year change in non-residential construction employment has really picked up nicely. It grew by 3.7% from August of 2022 to last month. Residential employment soared right after the pandemic when people rushed out to buy new homes or remodel and renovate and add to the ones they were in. But as those interest rates have gone up, mortgage rates in particular, home buying has really tapered off, home construction also. So we still have positive growth in residential construction, but I think that's about at an end, and that's likely to turn negative. Now, the picture does vary somewhat by state, but we're really seeing very strong conditions in almost all of the country. This map I update each month, and it shows construction employment fell in only 4 states from July of 2022 to July of this year. And growth was as strong as 10% in terms of the change in construction employment in Arkansas in particular from July of last year to July of this year. But many other states are in various shades of green, meaning they had some positive change in employment.
And Ken, it's wonderful for us to see that employment, by and large, except for maybe 4 states here, is up within the industry. And I know last time we spoke, there were a lot of firms that anticipated a need for labor growth, but indicated that they thought hiring might be a significant hurdle. Looks like maybe we've gotten over that hurdle, or, is there a baked in labor premium here or something that's driving this growth and making these upticks in labor possible?
Yeah, you just said the magic word, labor premium. There's what I call a wage premium to get people to come to work in construction. And one reason that construction firms were struggling to fill jobs earlier was that while historically the industry's always paid more to get people to work outdoors in the kind of heat most of the country's been having through this summer, and having to stay on a job from earlier than I like to get up in the morning to whenever that final whistle blows, that the premium shrank at the beginning of the pandemic because industries that historically had paid minimum wage or even less for tipped restaurant workers, I'm talking here about carry-out restaurants, local delivery, warehouses, they dramatically increased their starting pay. So that shrank that premium, but it has come back for construction as firms have been paying more lately. Let me show a couple more slides that get into that part of the story. First of all, you picked up on what I said about construction employment growing, but that's only part of the story. It still hasn't grown enough to meet demand. The chart here shows job openings at the end of July in each year in the history of this series. That's the blue line. And you can see it's really stayed flat at record levels for 3 Julys in a row. That is 385,000 job openings at the end of July 2023. And in fact, the number of openings almost matched the number of people hired during the entire month of July. And that's a sign that contractors, they may be increasing employment faster than the overall economy, but they want even more workers because there is so much work out there. In fact, the AGC of America does a survey every summer with Autodesk. We just released it right after Labor Day and found that 85% of firms said that they did have job openings. And of those firms, 88% said that they were having difficulty filling craft positions, 86% having difficulty filling salary positions. So it's really just about every type of position and many parts of the country having that problem. And one reason for that is the unemployment rate is so low. Every month you hear how it's been below 4% nationally across all industries. Well, usually construction is episodic, that when you finish a job, you don't necessarily get hired back for something right away. Not true anymore. This shows the unemployment rate in construction is way down there below 4%, almost a record low for construction unemployment. So there just aren't workers out there in the broader economy, let alone ones with construction experience, which is what this figure measures, who are looking for work right now. Now, here's that story on wages. It's a series that comes out with the employment report called Average Hourly Earnings. And the left side shows that the premium, as I call it, for working in construction was 20% or more for 20 straight years, right up through 2019. That is the difference in what construction pays for so-called production and non-supervisory employees, most of your craft workers and office workers who aren't supervisors, compared to what the total private sector pays. The average premium, wage premium, was 21.5% for 20 years. Then at the beginning of the pandemic, all those other low-paid businesses suddenly raised their wages. The premium shrank to about 15%. It's come back because in the last 12 months, construction wages have gone up 5.7%. That's really a huge increase from what we were seeing before the pandemic, when wages typically went up 2 or 3% a year. So wage bill for construction really going up a lot, more than in the overall private sector, where it's up 4.5%.
That's interesting, Ken, because you mentioned that the unemployment rates are low, so it's about finding new workers to gain that experience. But with that delta in the past, it was the wages, the higher wages that helped get people out of bed and take on those jobs in the heat. But interesting just to note, it's that construction almost has to reinvent that advantage, right? To add to that again, now based off a new baseline, which other industries having raised that. So just an interesting thing that you always kind of imagined those laborers being able to get a significant advantage in pay rate, but now firms are having to kind of reinvent that this time.
That's exactly right. And so I think the fact that those wages are going up even more in construction means that they may attract some workers back from other sectors, ones who had
Mhm.
hopefully had some construction experience or at least the right skills to do it. But nevertheless, they're going to be faced with that challenge of how do they cover those labor costs. Now, they have
Right.
gotten a break lately on most materials costs. This next chart shows in red a series called the Producer Price Index for inputs to new non-residential construction. That's a big mouthful that boils down to the change in cost for all materials and selected services like design and trucking services that are used in non-residential construction. And as we all know, there was just a tremendous increase in those costs from the middle of 2020 up until the summer of 2021. Then things seemed to level off. And then spring of 2022, Russia invaded Ukraine, and suddenly there was another jump in fuel prices, particularly diesel prices. Steel went up again. Well, that peaked in June of 2022. And since then, there's been a nice steep downturn in the rate of cost increases. In fact, it's gone negative overall in the last few months. You can see that red line below the zero mark for the last few months, meaning that the latest prices are less than the same basket of goods a year ago. But the blue line here shows what I was just talking about on the wage increases, that they've been sticky at 5.5%, much more than we had before. And so for many companies, of course, wages are the be all and end all, or at least they certainly count more than materials that may be somebody else's problem or that the contractor can pass on if they're lucky. Here's some examples of how those costs for materials have changed, because I don't want to paint too rosy a picture that while overall that combined basket of materials costs has declined, if you're buying cement or ready-mix concrete, those costs were still rising at double-digit rates from July of last year to July of this year. And the construction machinery, which is certainly important for many firms, those costs are going up as the machinery makers, they're passing along the higher costs they were incurring last year for steel and certainly for electronics and other parts and their own labor costs. So that's going to be a big bite. Now, with subcontractors, it's a mixed picture right now. These costs, while roofing is still growing at double-digit rates, electrical and plumbing and concrete contractors, they don't seem to be pushing through such big costs or pricing increases as we saw a few months ago. But I think these things are volatile, and if the cement and concrete costs are going up, I'd have to say you better expect those to be passed through too.
It seems with the changes in PPI inputs and labor premium both seem to maybe reflect sort of a normalization post-COVID. Is that kind of what we're reading here, or kind of what you're seeing in those numbers?
Well, what I think we're in for is still quite a bit of volatility, and that's what this next chart shows. It's a comparison of the year-over-year change in those materials input costs to the year-over-year change in what contractors, a select group of contractors, is telling the Bureau of Labor Statistics they would charge to put up a set of buildings. And BLS asks the same contractors each month, what would you charge to put up that same building we asked you about a month or a year ago? That they're asking a whole bunch of contractors about quite a range of buildings, but each one, it's a fixed change. So it's about as close as I think we can come to what is normally done with producer prices, asking a manufacturer or a gas retailer, what did you charge in actual price for that particular product? And so what you see here, the periods in red, are when contractors were hemorrhaging profits or they were underwater on their pricing in terms of what was happening on the materials costs. Lasted for 19 months with a huge peak, 3 times as high as ever before. Well, at the far right, you can see that for the last year, the materials costs have tapered down while the bid prices have not come down to the same extent. So contractors are getting it back. And if you look over the entire 16-year history of this chart, it's probably, you could flip it and you'd see about the same number of months above and below and the same total area above and below the zero line. You have to expect that if contractors were losing profits continuously, they'd be exiting. And if they were always making more profits than other folks, people would flock in. But at any rate, what I see here is that you have to expect things can shift very rapidly. The contractors are understandably hanging on to what pricing they can, given how much they endured for a year and a half before things turned in their favor. And also, if you look back, things can flip back and forth on a regular basis, as they did in 2012, 2013. So as the representative of the Construction Trade Association, I certainly don't predict or inquire about what contractors are doing on their pricing. But this chart says to me, and economics training says, you have to expect things are going to remain volatile and keep switching back and forth. Well, let's go on to what's going on with different construction segments. And here you see that the total construction spending from July of last year to July of 2023 was up 6%. That sounds decent. Unfortunately, these numbers are not adjusted for inflation. We don't have a single inflation measure that works for housing and hotels and highways and everything else. So we're left guessing how much of this is really additional housing units or lane miles of highways or whatever unit measure you have, how much is price increase. At any rate, once you start peeling back the layers of that onion, you see big differences. Private residential down 5%. In particular, single family down at double-digit rates. Well, that certainly fits the story we're hearing, that there's not nearly as much home buying going on, not as much single-family home construction. Multifamily, on the other hand, up by 25%. The number of units under construction, according to the Census Bureau, is at a record high of almost 1 million housing units, and that's a series that goes back 50 years. But I think that's being buoyed, if you will, or artificially extended by the difficulty that contractors are having getting HVAC equipment, switch gear, transformers. Once these units do finish off, there aren't going to be nearly as many starts or permits for multifamily. So this is an area where I think we'll see quite a switch. Also, the single family may have bottomed out, that people are reluctantly adjusting to the reality of 7% mortgages, and some people are ready to buy in spite of that. Now, on the non-residential side, you see good news on both private up 20%, public up 12%. The rest of this slide shows the different categories as defined by the Census Bureau and in descending order of July 2023 size. All of them in the black, meaning they're up overall. But just as we saw with the residential, there are some subtleties buried within these. There are parentheses that show the subcategories also in descending order. And the biggest driver for construction these days is the huge growth in manufacturing, particularly these electronics plants to make new chips and wafers in Arizona and Texas, Ohio, New York, and even Kansas is getting into this. So that's a very strong market. At the moment, this shows transportation equipment down, but I think that's about to turn around. We've had so many announcements of electric vehicle plants, battery and component plants, that I think we're going to see big growth in that area. And then many other manufacturers are making announcements or plans to build new capacity in the U.S., either because they want to shorten that supply chain, get away from conflict areas, or be prepared when that impact of that Build America, Buy America Act that requires projects getting federal funding to have U.S.-made components. So I think manufacturing, while it's already at the top of the league standings, has some of the best growth prospects of any of these categories.
It's certainly eye-popping, Ken, to see 171% growth for the computer electronics. That's a massive number.
That's right. It's almost tripled just in the last 12 months. And I don't think we're done yet. Now, there is one thing that I should really call out in the rest of this. I don't want to drag everybody through all the numbers, but the office category is up 10%. And that's got people scratching their heads until you see, including data centers. It's an eternal frustration to me that the Census Bureau doesn't break out data on data centers. But my guess is that data centers account for anywhere from a third to maybe even a half of this office category, so-called office category. If we could break out the data centers, also recognize that these non-residential segments include remodeling, repurposing even. So if you're talking just about new office starts, forget it. I think that market is moribund and going to stay that way until employers really figure out how many workers they want to have in the office and how much space they need for them and whether they can convince those workers to come in. So I do think that some things are going to change around here. For instance, we should see huge growth in alternative energy categories, but when depends on how soon regulations really get pinned down and investors have comfort that they'll be eligible for the tax credits. Contractors will have the confidence that the materials and machinery that they're installing meets the requirements of the Buy America, Build America, Buy America rules, a number of labor, apprenticeship, even child care requirements associated with these three big federal bills, the Infrastructure Investment and Jobs Act that was signed almost 2 years ago in November of 2021, but has yet to flow through into contracts. The CHIPS and Science Act that is clearly helping to boost that spending on the CHIPS plants that we talked about. And then the Inflation Reduction Act is really one that may produce the most investment. Tax credits, piled on tax credits for different kinds of alternative energy, even carbon capture and storage, if they can figure out the science and engineering to make that work. So to wrap this up, I'm still confident about the outlook for the overall economy. I don't think we're headed to recession. Now, I think I said the same thing when we last talked, and at that time, I was certainly in a minority. Now it seems most economists and investment analysts agree. That has me a little worried, frankly. It's a little easier to be an outlier than to look around and see how many economists who were wrong before now have the same opinion you do. Not that I have any better track record overall. But I think while the market for construction looks healthy overall, I do see big changes. Big drop in multifamily, most likely. Still a very weak market for office construction. A lot of vulnerability on things that require developer financing as those interest rates go up. The banks tighten lending standards. Rent stop rising or not as much to cover the additional financing and construction costs. But that will be swamped by continuing huge growth in data centers and manufacturing plants, and at some point in these infrastructure and power projects. The one continuing concern for contractors is going to be where the heck do we find the workers to do all these great big projects? And so I think the challenge there has gotten even greater since the pandemic because so many other jobs can now be done remotely or on a hybrid basis with flexible hours, things that just aren't possible for the on-site construction jobs. So I'm an optimist by nature. I'm optimistic about the outlook for construction demand, somewhat for materials costs, but I think that the labor challenges are immense. Wages sure to go up more.
Mm-hmm. Well, Ken, you have some great insights here with both the mid-range and long-run outlooks. If there was one in particular that's got your attention the most, that you're keen to kind of keep tabs on and see where that takes us, what would you say that number one outlook would be?
I'm really hopeful that we can sort through the regulatory and judicial challenges to getting that money that Congress promised over the last 2 years turned into projects out there to bid and contractors having the confidence to bid on them. So I would say any contractor that is looking for a growth category should be looking for the infrastructure and alternative energy markets, that those are going to be in varying degrees happening all over the country, but they certainly do have these hiccups or these challenges in terms of getting through the design and awarding and legal process.
Yeah, I was actually going to ask about that, Ken, just to kind of dovetail that point. I know you also track Architectural Billings Index, which is something I'm always interested to see in your reports. As a kind of a leading edge indicator, what are you currently seeing with that? Is that remaining relatively stable and flat, increasing, decreasing? Is there anything to glean from that?
Well, the Architecture Billings Index comes out from the American Institute of Architects in the third or fourth week each month, based on a survey they do of several hundred architecture firms. And they ask a simple question: were your billings higher or lower than the month before? And if more firms say higher than lower, they put that index value above 50. And it's been hovering very close to 50 overall for the last, I think, 4 months. Now, they have sub-indexes tracking multifamily, which basically means your higher-end apartment or condo projects, and then for commercial, industrial, and institutional, and then a mixed practice where no one type predominates. Those indexes have fluctuated a little more than the overall index, but I would say they're not particularly encouraging. They're more or less stable, so I don't expect a big plunge, although the multifamily has been looking pretty weak lately, and that fits with what I was saying about the drop in permits being taken out as reported by the Census Bureau. But the ABI naturally is following what architecture firms do. When we're talking about offshore wind, you don't have a lot of architecture associated with that, or massive solar fields, or underground utilities, or carbon capture projects. So I'm not saying they're missing their market. They're focused on architects, but for contractors who are doing more engineering-focused work, I think the picture is brighter.
Fantastic. It's good news for us all. Ken, certainly appreciate you taking the time to chat with us today. If any of our listeners want to hook up with you afterwards, where can they find you?
Right here, Ken.Simonson at agc.org, and I'd be glad to send along my PowerPoint and also sign people up for a weekly data digest, a one-page summary of economic news relevant to construction. You can also find a link to the survey that we just posted and a lot of other information at agc.org.
And I encourage people to sign up for that weekly email. There's a lot of great information in there, and I enjoy following that every week. So thank you again for coming on with us today, and we look forward to having you on again real soon.
Okay, thanks, guys.
Thank you for listening to The Building Bite. This podcast has been brought to you by Proactive. Check us out on thebuildingbite.com, where you can subscribe to our newsletter and follow us on social media for all future The Building Bite news and updates. You can also find us on your favorite apps, including Apple and Google Podcasts, Spotify, Stitcher, TuneIn, and Amazon. If you have ideas for episode topics that we should cover on the show, or you know somebody who would be a perfect guest, let us know at connect@thebuildingbite.com.